Our mission at Resilient Advisor is to have a significant impact on the retirement crisis by educating and empowering financial advisors to better serve their clients. We bring you industry thought leaders and experts to help you make a difference in the lives of your clients.
Thanks for tuning in to this episode of The Resilient Advisor. My name is Jay Coulter, and joining me for this regularly scheduled episode is Michael Guyette, publisher of the Lead Lag Report, portfolio manager at Toroso Investments, and member of the ETF Think Tank. Once a month, he comes on and we talk about risk and risk signals. Michael, thanks for coming back on.
Always a pleasure, Jay.
All right. So before we get started talking about actual signals that you're seeing in the marketplace, and I like to run down through my list of things that advisors might be watching. What are your macro thoughts on risk signals today, given this environment that we're in?
So, it's interesting because I've been kind of sounding the alarm on sort of this rolling series of warning signs, right? Whether it's small caps having gone nowhere since February, treasuries having rallied and dropped in yield since mid-March, lumber to gold collapsing since early May, utilities against the stock market now showing some early signs of outperformance. And, it's one of those things where I get comments from people on Twitter saying, well, you haven't been right yet on sounding the alarm for risk. I actually kind of agree, right? Meaning that you have not had volatility pick up. All this may still be false positives in the sense of, what these things are suggesting. But I don't mind slowing down and entering the storm. The reality is if you've been in treasuries, if you've been defensively postured, you still made money, even though you haven't had the market itself going down. And I'm okay with it being a false positive. I don't mind being wrong and making money. I do care about being right and being really right when it matters the most, which is during these tail events. And remains to be seen, right? I do think that the conditions are still very much there for a lot of the things we've talked about before. But so far, at least, it looks like it's kind of status quo for most of the bull narrative.
So when you think about some of the papers you've written around risk and diversifying your risk signals, obviously there's a lot of application right now for advisors. Without having to go and read the paper, what should advisors take away from diversifying risk signals?
So look, whenever you're tactical, and I run 3 funds, each of them are very tactical, using different signals, variations of risk on, risk off in concept. You're going to have times when certain signals are wrong, certain positions are wrong. And when you're very active, that's natural, right? But you never really know which risk signal is the one that actually is going to result in a true positive. You don't know which one is the one that's going to help you just in the nick of time. So from a product perspective, from my standpoint at least, I created 3 different strategies with 3 different funds, which tend to all be defensively postured in treasuries when you need it the most, even though they're following different triggers. But in between where the signals are wrong is where there's different types of positioning. And no different than diversifying a long-only investment beta portfolio, I think it makes sense to consider diversifying your signals as well, because you don't necessarily care so much about being wrong when you're defensively postured, because, all right, you're wrong and market goes up. What you care about is being offsides, is the false signals, is the false positives, where you're in stocks and stocks go down, or you're in treasuries and treasuries go down. The only way to mitigate that is to try to have as many different statistically proven leading indicators to risk, just to blend against each other, because if you do that, you get sort of a better portfolio experience.
Has there been any academic research on how many different diversified strategies you should have in that type of basket?
Yeah, good question. I mean, nothing that I've seen. I think the harsh reality is that there are not that many true leading indicators to risk, at least from a sequence of return standpoint. And of all the papers I've put out there, they all basically try to tell the same story, which is what is the likelihood of the demand for money changing, right? Because whether it's utilities against the stock market, long duration treasuries against intermediate, lumber relative to gold, all of those are interest rate sensitive groups. They're all proxies for interest rates. They just signal at different times, but usually they'll kind of give the same signal if it's a true positive, which it seems like they are, at least right now. So it's hard to know. I think a lot of people, unfortunately, they fail to understand what diversification ultimately means, because a lot of things do tend to move off of the same risk factors. Ultimately, correlation is the key part of it, but what you really want everything to be correlated to is risk off periods when markets get volatile. You want diversification in between, and I mean, I think from a strategy perspective, certainly more than 2 probably makes the most sense.
Yeah, you would just think simple math, more than 2 would be very helpful. I wonder if it's even possible to over diversify your diversifiers as well. I'm sure there's some academic that's written a paper about it. We'll talk about that on another show. Let's talk about some of your diversifiers, though. Let's start with your newest ETF, JOJO.
JOJO, so junk on, junk off, credit rotation ETF. So that uses the behavior of utilities against the stock market. So this is kind of I always say this is kind of an interesting dynamic. You can always have faith that an anomaly is real. The anomaly that I'm most known for are these leading indicators to tail risks, to extremes in risk assets. You can have faith that an anomaly is real if a trend sends a particular opportunity set. So in this case, if utilities are outperforming the stock market, volatility tends to rise, as shown in the 2014 Dow Award paper going back to the 1920s. Well, when stock market volatility rises, you tend to see credit spreads widening. Treasuries benefit, high yield sells off. So in that case, that ETF goes junk off fully in treasuries. Otherwise, if utilities are underperforming the stock market, lower stock market volatility likely, that ETF goes all in junk on into high yield. So it's really just playing with credit quality. Now, what's interesting here is spreads look pretty early in terms of widening, meaning utilities are starting to outperform the stock market on a short-term basis. We know spreads have been incredibly tight, and the time to worry about bonds is when spreads are very tight. Public information, the ETF is fully in treasuries as we speak. Now, because the approach is weekly, for all I know, that could change come end of the week. But if indeed you have a juncture where risks do manifest and it's a true positive, that's a great thing, right? Because if you can avoid high yield becoming higher yield, meaning you're avoiding that sell-off in junk debt, then you can go back into high yield at a much more juicy type of income level. Right. And I think this is kind of the tricky part with the bond market. Everyone knows that the single determinant to returns is starting yield. Well, starting yield for most bonds is nothing, which means really the only way you can get yield is being tactical and waiting for the moment for those dislocations to occur to then really, go aggressive and get that higher yield when it presents itself.
All right. So let's take apart RORO the same way.
So RORO uses lumber relative to gold. And again, all these signals are interest rate sensitive proxies. Utilities, the most bond-like sector of the stock market. In the case of JOJO, lumber to gold, housing, mortgage rates, negative real rates when it comes to gold. So they're all trying to get to the same place, but in different ways. Lumber to gold has been warning really for a while. Actually, a pretty prolonged period. A lot of that's because of the vertical move that occurred up to the lumber peak early May. And that move has actually been kind of right, meaning if you look at the way lumber to gold has been weakening, suggesting risk off, typically when lumber to gold is weak, small caps underperform, check. Treasury yields tend to fall, check, right? You have not had volatility in the stock market rise, but at least behaviorally, other parts internally are consistent with the historical behavior of lumber to gold. Right now, that's signaling risk off for RORO. So both RORO and JOJO as ETFs are in the same position in treasuries. But again, every single Friday, those signals could flip, which means one could go risk on, the other one could be risk off, so on and so forth. But again, typically in advance of major declines, they will both look similar because the real risk off expression is treasuries. Lumber to gold is kind of interesting here because lumber utterly crashed. And it seemingly still wants to keep crashing. Meaning that if you look at, it's like I always make this point about mean reversion. Mean reversion means you have to go past the mean. Right? You have to go past the prior average from the last several decades, which means lumber could still drop another 30% to be perfectly normal. The implication, though, is what does that mean for housing? And we're seeing housing starts and housing data slow down and weaken, aside from the fact that housing has become completely unaffordable for most people now. You're probably going to see a slowdown in construction, which probably means a slowdown in credit creation, which probably means a slowdown in the economy, which probably means higher volatility.
Excellent. And we would be remiss if we didn't talk about the ATAC mutual fund as opposed to the ETFs, JOJO and RORO. How do you manage that strategy?
So unlike RORO and JOJO, ATAC uses a combination of signals and has an additional relative momentum trigger. So it's kind of a different beast to some extent, although still trying to benefit from risk off. Last year was a banning year for that mutual fund. This year, not so much, largely because of whipsaws around small caps, that relative momentum filter, which RORO and JOJO are not, don't have as part of the sort of allocation decision. But again, all funds are trying to do the same thing, right? I always go back to that, this idea that if you want to kill it in the stock market, you have to not get killed. A lot of people get overly focused on the upside. The downside, it's like if I were to show you, a study that showed if you capture only 50% of the market's upside and 50% of the market's downside over the last 2 decades, you would have destroyed buy and hold, even though you're only capturing half of the upside. You're lagging most of the time because markets tend to go up more often in time. But if you happen to get 50% of the downside, that down capture is what really drives your returns much more than pedal to the metal, buy and hold. People forget that. And I think it's hard for people to intellectualize it when increasingly attention spans are shorter and shorter. And what that means in my world of risk on, risk off is that there are going to be plenty of times where everything I do looks like it's lagging or not really that interesting. And then suddenly it works in a big way because the tail wags, because the black swan appears, because the conditions that favor the accident actually result in the accident. And the funds, hopefully, more often than not, are positioned in advance of that. Correctly so.
All right. So in your world of risk on, risk off, it's not about a trade. It's about an allocation decision in reaction to market conditions based on some rules. Is that fair?
Exactly right.
All right. So let's talk about some topics I'm getting from financial advisors today that they're thinking about in their portfolio construction process. And you alluded to small caps earlier, but what do you do today as a financial advisor with new money that's requiring an allocation to small caps?
Yeah. So it's interesting because the small caps have been holding on to this pretty strong support level. If you look at the Russell 2000, it's bounced on this support level for quite a while, having gone sideways since February. Now, the length of time with which some of these signals, in particular lumber to gold and treasuries, have been warning, I think you're kind of at a very important inflection point, meaning if you're going to have a true positive, it probably has to happen soon and quickly, meaning volatility rising, in which case, if you're looking to allocate capital to small caps, you want to wait till after that happens to buy at much lower prices. Having said that, what if it's a false positive? What if all this stuff, all these signals are wrong, which is very possible, and they start turning back up, signaling risk on? Lumber to gold turns up, utilities re-weaken, treasury starts selling off. Small caps probably have the most juice on the upside because they've lagged for so long. There could be a catch-up trade in the event that all the risk triggers are false signals. So what I would suggest is that it probably makes sense to slowly dip in, and then I think in a few more weeks, a lot of these risk signals will kind of resolve themselves, which is good news for advisors because it means you don't have to wait too long. But I think actually small caps would be the place to really allocate aggressively to. You just might want to wait to see if there's resolution around the risk triggers.
All right. So then same context for looking at Chinese equities. Right now, you're looking at new money. Let's say your models do have exposure to mainland equities. How do you look at that today through that risk on, risk off lens?
Yeah, it's tough, right? Because obviously China, unlike the U.S., has its all kinds of other country risk involved. So it's hard to sort of see how that plays neatly into the risk on, risk off signals, which are more in the U.S. centric viewpoint. Look, I mean, I'd be shocked if China goes full on anti-financial markets. And there probably is opportunity in Chinese equities. The challenge, of course, is you probably have to weight it less than you otherwise might want to, even if you're ultra bullish, because of the exogenous risk of the government coming in again and doing something. So I think that probably makes sense from an international allocation standpoint to buy low ultimately, but there's just no way to know how that risk, that unknown factor of the government coming in kind of would play into it.
All right. So I'm going to combine the next two together because I think they play off each other. This infrastructure bill and inflation. So, and specifically for advisors that are fielding incoming questions from their clients who are questioning decisions in the portfolios that they're managing for them based upon those two things that have a lot of headline risk. What is the risk on, risk off narrative for both of those?
Well, I think if infrastructure passes, depending upon how much actual infrastructure there is and the way that it occurs, right? I think the issue here is that it may not be as much of a shot in the arm as people expect. And that's probably why commodities have, kind of languished as of late. Keep in mind also that infrastructure spending is trying to get jammed into the system, but we still have a debt ceiling to get resolved, which is a little bit strange to me. The government's basically debating spending more money, even though they haven't agreed on increasing their credit limit. Again, they're going to do it. I keep going back to it. It's not a question of whether they do it, but if the credit rating agencies enter the conversation, well, then you're not going to have infrastructure spending because it means the credit quality of the U.S. government is at risk. So, and I think also that's probably in the subconscious of the market, probably why commodities haven't really done all that much momentum-wise. On the inflation side, this is also what's kind of strange, right? Because you would think if you have added fiscal stimulus, that's going to push inflation expectations even further. and people are already screaming about the cost of goods, right? So I think this is a very delicate line for the government to walk, right? Because yes, clearly you need to do infrastructure. There's a lot of pork in the bill. It looks like a lot of money is going to be thrown into things when you don't even have enough people that can do infrastructure from a labor perspective. I mean, you can see that from contractors. If you try to get anybody to do anything on your home, right? It's hard to just find the skilled labor. And then you add this whale in terms of the demand for raw materials, at least for a portion of the infrastructure. Well, now suddenly everything gets more expensive, and everyone's already saying, well, I can't afford this. And you look at things like data on real wages. People have actually lost purchasing power despite all of this economic boom that we're seeing coming out of COVID. Mm-hmm. So it's going to be tricky. I think is the only way to say it. I'm a big fan of the idea that nothing matters until it matters, and then when it matters, it's the only thing that matters. I don't think the infrastructure bill is going to matter as much as people think. I think the debt ceiling and the credit rating agencies will be all that matter very soon.
Yep. And in fairness to people who are tuning into our show for the first time, you've been saying that for a while now, along with the inflation narrative.
And listen, I could be totally wrong, and that's okay. I keep going back to this. People get too obsessed with a signal or a thesis being right or wrong. Markets don't follow a normal distribution. The batting average analogy when it comes to anything, when it comes to this business is nonsense, right? Because you just need a couple home runs, and that's what wins the game. You don't need to keep getting up at base, right? So you can keep striking out, keep being wrong, and then if at some point you get one of those big moves, well, then suddenly you're way ahead of everybody else.
Yep. And to get back to your comments from earlier, protect yourself on the downside. You don't have to get full capture on the upside. All right. I'd like to switch gears. Over the weekend in Seeking Alpha, you have a piece on SIL. Tell us what are your thoughts around the company, and if advisors were to go to Seeking Alpha and read this piece, what's the takeaway?
Well, so this is more on the sort of space, the ETFs, silver miners, the space of silver miners. So the interesting thing about silver, right, is that you've got a lot of potential big demand coming because of all this focus around renewables and EV. Right. If you have, I think part of the infrastructure bill is that by 2030, you have a substantial amount of vehicles that are electric. That's going to be a longer term secular source of demand for silver, because silver goes into solar panels. Silver actually goes into a lot of things that are ESG related. So I think there's this really big tailwind that favors the commodity itself. The companies you would think over time should benefit from that demand, because obviously they're selling that silver on the mining side. Silver miners have not done really that much, but that's okay. I mean, again, I go back to, I think buy low is ultimately how you make money, not buy high.
Mm-hmm. Yeah. Great piece. I've been following silver for a long time. It's a very frustrating investment space. And I thought your article did a great job of articulating why some of those frustrations are there. Let's wrap up with the most important topic of the day, Michael Burry versus Cathy Wood and ARK. How do you see that playing out?
Well, first of all, I think we got to distinguish something here. I mean, I know the media is making it out to be like this battle between the two, and it's kind of interesting to watch. But he could be just doing that position because he's just bearish on the market overall and views innovation beta stocks as the area which will get hit the hardest. It's not necessarily sort of I don't think an issue against ARK, but just sort of a way of getting even more leverage to beta when it goes down, right? And keep in mind, I always make this point: there are no gurus; there are only cycles. Michael Burry made a ton of money. Cathy Wood made a ton of money. That doesn't mean that they're always going to be right. Burry, I believe, also has been very much betting on rates rising, yields increasing. He has been very, very wrong on that, at least so far. And remember, there's always a fine line between being wrong and early. So I think it makes for interesting theater. I don't know if it's actually something that anybody can glean any signals from. It's just something that's worth paying attention to, if anything, just to see what the biggest players are doing, so that we have something entertaining to watch.
It is entertaining, especially in the Twitter sphere. Let's wrap up with the ETF Think Tank. You and your team have been doing a great job with it. Tell financial advisors who are watching what they would get if they subscribe to the ETF Think Tank and tune into your shows.
So, I've been very fortunate to be a part of the group because we have a lot of high-level relationships with different ETF issuers and sponsors that we work with. And we offer services to advisors for free basically for them to be the audience to a lot of these issuers. I do a lot of social media work with advisors. We offer research, not just the Lead Lag Report, but we've partnered up with several others that have large names and are providing those services in addition to the educational information from the ETF sponsors themselves. So for advisors that are kind of curious, I mean, we're happy to engage with you. I think increasingly it's becoming more and more my belief that this is not an industry where we're competing against each other. There's a lot of money out there, and we're all just trying to help each other and help advisors grow their books of business, grow their practice, grow their knowledge base. Because to the extent that they grow and they expand their thinking, that's a big plus, not just for their clients, but also for us at the firm at Toroso, because that's part of our network as well.
Yeah. You guys put out a ridiculous amount of high quality content. You guys have a show on Tuesday for financial advisors. And then on Thursday, you do a happy hour. What are those typically like?
So the Tuesday shows are not as regular. The Thursday get Think Tanks. Happy hours, we always have a special guest. We have you coming up soon, as you know. But we have a lot of very, very smart, interesting guests, kind of like a casual conversation with some light drinks about markets. It's all been very well received. Gets good views on Twitter. Look, we're in a world where content is king. Content marketing is everything. Advisors know that. Individuals are aware of that. Just as long as you bring out quality content, you'll be able to kind of grow your reputation, grow your connections, grow your firm.
Excellent. For podcast listeners, visit etfthinktank.com to learn more about what the think tank could do for your business. To follow Michael on Twitter, he is at Lead Lag Report. And then you can learn about his newsletter by visiting leadlagreport.com. That is leadlagreport.com. Michael, once again, I appreciate you coming on this month.
You're the man, Jay. Appreciate it.